Crypto is at the tipping point. Global liquidity continues to hit record high after record high, and historically, Bitcoin has always followed this breakout. It's because significantly more money is circulating in the world economy, and it eventually always finds its way to risk assets like crypto. What's adding fuel to the fire is the fact that the US dollar had its worst performance in more than 50 years. Investors are turning to crypto to hedge against inflation and a weakening dollar. And the fact that ETFs are in play is pushing everything up even further. The Bitcoin spot ETF total flow is about to hit $50 billion. And that's while Bitcoin is simply flirting with its all-time high. Analysts are predicting some pretty serious movement, and one of my favorite macro analysts on X, Marty Party, is predicting 165K in October. His TA considers institutional investors quietly accumulating at low prices, and a golden cross, which is when the short-term price average crosses over a longer-term average. Others are forecasting 200K by the end of the year, and this really seems to be the calm before the storm. Most people would take this information and rush to get their hands on some more Bitcoin. But in this video, I'm talking about something that most of you may not be aware of. Something that you probably hear about but choose to ignore completely. And this stat is going to shock you. The derivatives market accounts for 75% of crypto trading volume worldwide. Crypto derivatives are contracts that let you bet on or hedge against crypto price changes without owning the actual coins. And whether or not you trade derivatives, it's important to understand them because they have such a big influence on crypto prices. In this video, I'm going to cover two very important charts that some of the best analysts out there live by to make their market predictions. The biggest crypto exchanges in the world use these metrics to manipulate the market. We're going to talk about it. I'm even going to give you a crash course on futures. Whether you're brand new to it or not, by the end of this video, you're going to be equipped with an entirely new set of tools. So let's not waste any more time. Hit that like button and let's get started. To fully grasp the two charts I'm about to reveal, you have to understand the very basics of futures trading. So let's break it down. Imagine you're betting on the future price of Bitcoin without actually owning it. Perpetual futures trading lets you do this in the crypto market. Perp futures are contracts you trade on a crypto exchange like WEEX, where you agree to buy or sell a crypto at a certain price, but there's no expiration date. Unlike traditional futures, which end on a specific day, perp futures can be held indefinitely as long as you have enough money in your account. You can either go long or go short. A long is if you bet that the price of Bitcoin will go up. If the price rises, you profit. A short is a bet that the price will go down. If the price drops, you profit. And then there's leverage. Perp futures let you trade with borrowed money called leverage. For example, with 10x leverage, you can technically trade $10,000 worth of Bitcoin with just $1,000 of your own money. This boosts your profits if you're right, but also your losses if you're wrong. There's also the margin. To open a perp futures position, you need to put up some money as collateral called margin. Think of it as a deposit to prove you can cover potential losses. If the market moves against you, you can get liquidated, which means you lose your margin and position. Here's a concrete example. Let's say Bitcoin is at 100K. You think it'll go to 120K, so you go long with 10x leverage. That means you'll put up $1,000, but your actual position will be $10,000 of Bitcoin. If Bitcoin hits 120K, your position is now worth $12,000. So you make a profit of $2,000 minus fees. So you've effectively gotten a 200% return with just a 20% price movement. But here's the risky side of things. If Bitcoin drops to 90K, you lose $1,000, wiping out your margin, and your position gets closed. This is called getting liquidated. You lose everything with just a 10% price movement down. So perps futures let you bet big on crypto price movements with small amounts of money, but they're risky because prices can swing fast and leverage magnifies everything. Now that you have the basics down, the first critical metric I'm covering today is open interest. But before we go any further, I want to remind you that this video is for educational purposes only and is not financial advice. I'm not a financial advisor. Crypto is risky, especially when you're trading futures. So do your own research and make decisions at your own risk. And with that said, back to open interest. Open interest is the total number of active contracts for derivatives like futures on an exchange. It's an important metric even for non-futures traders. If you're trading spot markets or holding long term, you still need to know this. Open interest matters because futures markets heavily influence overall crypto price trends and volatility. Open interest helps us understand what's really happening behind the price. When open interest is rising, it means more positions are being opened. So more traders are stepping in, and that usually confirms the strength of the current trend. For example, if Bitcoin is climbing and open interest is also going up, it shows new buyers are entering the market. That reinforces the bullish momentum and gives traders more confidence to buy or hold. But if Bitcoin keeps going up while open interest starts dropping, that's a warning sign. It could mean traders are closing their positions and taking profits. That can signal the trend is running out of steam and it might be time to get cautious. Open interest is also a key signal for spotting volatility. High open interest usually means the market is packed with leveraged trades, which can cause bigger price swings. On the flip side, low open interest means a quiet market with less people participating. That makes it easier for sudden, unpredictable moves or even manipulation. And I'll be exposing some of that manipulation later in this video. But open interest gives us insight into sentiment. So let's say Bitcoin is falling, but the open interest is going up. Well, that could mean more traders are putting in short positions, which means they think the market is going to drop. That tells you there's conviction behind the move. Here's an example. Let's say Bitcoin is pushing up towards 110K. You check CoinGlass and notice open interest is up 10% this week and volume is climbing too. That means traders are opening new positions, backing the uptrend. So you decide to enter a long, but here's a real example from earlier this year. The price of Bitcoin was pushing up, but open interest was falling. That's a red flag. Traders were cashing out and momentum was fading. We saw a spike up, but then the price came back down sharply. And in this type of scenario, you would just adjust your stop loss or take some profits. So now we've seen how open interest helps confirm trends, understand sentiment, spot volatility, and improve your timing. It's one of the most overlooked tools, but one of the most powerful. And before we jump into the next metric and chart, one quick thing for all you crypto traders out there. I always get asked about my favorite exchange to use, and the truth is, I don't have one. There's too many hacks and downtimes to rely on just a single platform. Even exchanges like Coinbase have had major outages all the time. That's why I use over 10 exchanges. And one of my main ones is WEEX, especially for futures trading. They have some of the lowest fees in the game, no location restrictions, and getting started is as easy as signing up with an email. If you sign up with my link down below, you'll get a 200 USDT bonus and a chance to earn thousands more in rewards. With that being said, let's move on to the next metric. So this is one of my favorites, liquidation levels. So liquidation levels are price points where leveraged positions in the crypto futures market get automatically closed by exchanges. This happens when a trader's margin can't cover their losses anymore. It's called getting liquidated. So here's 3 price charts with all the liquidation levels layered on. Anything below the current price are all the long traders' liquidation levels. If the price reaches any of these levels, these traders lose their margin and get liquidated because the market moved down against their long position. Anything above the price is the same but for short traders. If the market moves up but they shorted the crypto, then they get liquidated. The red lines are high leverage positions, the orange ones are medium leverage, and the blues are low leverage. While all of this sounds like something only futures traders should care about, liquidation levels matter to everyone because they can trigger big, sudden price moves. So let's say Bitcoin is sitting at 110K, but there's a big cluster of long liquidations down at 105K. If the price dips to that level, it can trigger a wave of forced selling. That adds downwards pressure and can cause the price to fall even further. The same works in reverse for shorts. If price pushes into a zone packed with short liquidations, the forced buying can cause a quick spike upward. These levels also help us form support and resistance zones. A big cluster of long liquidations below the price can be a good bounce point and buy zone, and a cluster of short liquidations above could be the point where traders sell. The distribution of liquidation levels also shows us what traders are thinking. Here on this liquidation map, we can see that there's more longs than shorts. It means that the market is bullish. But there's also a good amount of people betting short. It's useful to know this because when too many people lean in one direction, markets are at a risk of moving the other way. It's a simple way to spot extreme sentiment. And finally, liquidation zones can also expose manipulation risks. Big players sometimes push prices into these areas, on purpose. They want to trigger liquidation so that they can profit. Let's shine a bit of light on one of crypto's darkest controversies. But another quick thing before we do, if you're enjoying what's being covered in this video so far and want to go deeper down the rabbit hole, then you should consider joining me in the FireHustle VIP Discord. I'm in there every single day talking to all of you and working with my team to deliver some of the best crypto education, market updates, macro analysis, technical analysis, portfolio updates, and a lot more. Check out the link down below if you're interested. Now let's get back to that controversy. So some crypto exchanges like Binance hire firms like Wintermute to manipulate prices and force traders out of their leveraged positions for profits. These firms are supposed to add liquidity to the market, but exchanges can use them to push prices towards specific liquidation levels. So for example, if Binance sees that there's a big cluster of long positions on Bitcoin that would liquidate at 107K, it might tell Wintermute to sell a lot, dropping the price to that level. This triggers a wave of forced selling, letting the exchange cash in on fees or take the trader's margin. Or they might push the price up to wipe out short positions with forced buying. Using Wintermute's fast, high volume trading, exchanges create price swings to hit these levels, making it look like normal market activity while profiting at the expense of regular traders. And this isn't just a suspicion. This manipulation has been well documented and tracked with on-chain analysis, but both Binance and Wintermute deny doing any of this. And they're not the only companies that have been accused of this. But one thing to know is that it's easier to manipulate the market when there's less liquidity out there. When things are booming, it takes a lot more for any single player to move the market. So we should see less and less of this as the market heats up. We've clearly seen that the crypto market is dynamic and very complex. It's driven by powerful forces like global liquidity, investor sentiment, and massive influence of futures trading. Understanding metrics like open interest and liquidation levels is important for anyone making smart moves in the space. By using these tools, you can spot trends, predict volatility, and even protect yourself from market manipulation. Whether you're a seasoned trader or just starting out, now is the time to dive deeper, stay informed, and take control of your crypto journey. If you enjoyed this video, please give it a thumbs up and subscribe to the channel. Please remember that nothing that I cover is financial advice and is for educational purposes only. If you're interested in trading or even dabbling in futures, be sure to check out WEEX. The link is in the description below. I hope you guys enjoyed the video and I'll see you in the next one.